Hey everyone, welcome back to Corporate Decoder, the place where we transform SEC filings into stories you can actually understand. Today, we're diving into FNB Corporation's latest annual report, and let me tell you, it's got more twists than a pretzel. Will this Pennsylvania bank continue its impressive growth, or will rising interest rates and potential legal troubles throw a wrench in their plans? Let's decode. First, a quick overview. FNB Corporation is a big regional bank, not some fly-by-night operation. They've been around since 1864, offering everything from checking accounts to wealth management in several states, mostly in the Mid-Atlantic region. So how did they do last year? Well, the report starts with a look back at the year. We need to know where we've been to guess at the direction we're heading. The company is reporting nearly $460 million in profit available for shareholders, but operating earnings, which usually strip out one-time events for a clearer view, were down a bit. Think of it like this. Imagine your base salary at your job stays consistent, but your bonuses fluctuate, depending on the company's overall yearly performance. We're seeing that although profits are high, it was a difficult year. But it's good news on all these important markers. They're touting records in non-interest income and growth in capital. Let's unpack what drove these results. And we see that FNB ended the year with assets of nearly $49 billion and a record high market capitalization, meaning how much the company is worth based on the stock price, which is around $5.3 billion. Seems like things are going pretty well. Let's dig deeper. One thing the bank did is dump some of their low-yielding, available for sale, that means they could be easily sold if needed, securities. And it looks like they reinvested the money into investments that had much higher yield. It's like trading in your old gas guzzler for a hybrid better for the environment and your wallet. Of course, in FNB's case, it is just for the bottom line. What's really driving things is solid loan growth. We are seeing a 5% jump over the year with both consumer and commercial lending on the rise. And even better, they also pulled in almost $2.4 billion in new deposits. This is key. That's a lot of people entrusting their savings to the bank. Now for the less exciting but equally important stuff. Banks have to maintain certain reserve levels, meaning cash set aside, and that ratio was 1.28%. Throughout 2024, the Federal Reserve cut interest rates. This will influence not just what FNB can earn on loans, but also what they have to pay out on deposits. A bank like FNB needs to ensure that it's in good graces with the regulatory agencies if they want to keep expanding. Regulators can really put the brakes on expansion, acquisitions, even simple things like paying dividends to shareholders if they have concerns about how the bank is run. So where does FNB operate and who are they up against? They've got a footprint across 7 states and DC, hitting major markets like Pittsburgh, Baltimore, Cleveland, and the Carolinas. That said, they face fierce competition from both traditional banks, credit unions, and the newer fintech companies trying to steal their lunch. Now let's talk about the folks running the show. FNB seems to be proud of their employee programs, touting awards and recognition for their positive work environment. Happy employees often translate to better customer service and a stronger bottom line, so it's always something to watch for. But it's not all sunshine and rainbows. There are fair lending laws that prohibit discrimination, and it looks like one of their acquired banks, Yadkin, had some issues that resulted in a settlement with the Department of Justice. This settlement requires FNB to invest millions in underserved communities, which could be a good thing for their image, but also a drag on their profits while the cost of compliance is high. They're also potentially facing greater challenges to getting approval for more acquisitions from federal regulators, which could stifle their future growth. Let's not forget what the company sees as its major risks and uncertainties. First, they admit that, like any lender, they're heavily exposed to credit risk, basically, the chance that borrowers won't pay back their loans. They are aware that their mortgage business is sensitive to economic conditions. They also have some concerns around liquidity, so holding enough cash on hand to meet obligations, and how their capital levels could be impacted by several economic changes. The company makes sure to note that fluctuating interest rates could hit them hard. See, they're always trying to walk a tightrope, charging enough interest on loans to make a profit, but also keeping deposit rates attractive to savers and consumers. Brand image also makes an appearance as an important risk for the company. It is basically stating that they need to keep their reputation in check. That could hurt their ability to attract and keep customers. Speaking of reputation, they have an ethics hotline to report any issues that could cause financial or reputational damage, and the company encourages anyone who has concerns to report it. Also noted in the report is that cybersecurity is a growing risk, so they are also required to notify their regulators of any cyber incidents no later than 36 hours after discovery. What I'm gathering here is that it's becoming increasingly difficult to balance their financial health, how they manage their employee base, as well as the legal and regulatory compliance that they are under. It is a tough balancing act. And in June 2024, the FDIC released a final rule that requires covered IDIs to develop and submit detailed plans demonstrating how they could be resolved in an orderly and timely manner in the event of receivership. What this does is to make it more challenging for them to acquire other businesses and grow, since it increases the costs that the new entity will be exposed to. Finally, let's briefly look at the leadership. There are no major changes to the executive team. It seems the same folks are at the helm. FNB is setting the stage for sustained performance with its team of veterans at the lead. There is a notice from the company, and it's important. FNB may need to raise more capital in the future to support growth, which could mean they have to issue stock or take on debt. This is an important indicator of their financial condition and something that we will be sure to follow up in the next report. The company also warns about regulatory scrutiny regarding their overdraft fees. Lastly, the company makes sure to note that they could get hit with potential lawsuits with significant monetary damages. Okay, so what's the big picture? FNB seems to be doing a decent job in a tough environment. They're growing loans and deposits, but they are facing higher interest expenses and increased regulatory and legal costs. It's important to note the risks around increasing expectations around environmental, social and governance and diversity and inclusion issues that could result in higher compliance costs. I appreciate that the company seems to be serious about employee satisfaction and retaining the workforce during a time when there are many people leaving their jobs. While revenue is growing and they are profitable, they may have issues growing in the future, so be aware of that as we look to future reports. The risks and opportunities here seem balanced for now, but we'll need to watch those interest rates, legal issues, and employee costs moving forward. Thanks for watching. If you enjoyed, please subscribe, like, and comment. What do you think is FNB's greatest strength and its most important threat?